Gather around, my friend. Let me tell you a story about a hidden force operating quietly behind the flashing numbers of the markets. Fair value gaps, or FVGs, as seasoned wanderers call them, are a magnificent tool to weave into your daily trading strategy. But wandering blindly into the market arena and trading every single gap you stumble upon is a fool's errand. If you are genuinely interested in wielding their true power, you must first deeply understand what actually breathes life into a valid, usable, fair value gap. So, settle in, for I have carefully broken down everything you will ever need to master this art into 7 distinct, easy-to-follow tales of wisdom. Before we delve into those specific secrets, we must first understand the ancient mechanics of how they actually form on your screen. Close your eyes for a moment and picture your trading view canvas. Imagine a sequence of 3 consecutive, towering green candles surging powerfully upwards, one after the other. Hidden within the very formation of these 3 pillars lies the bullish fair value gap. This mysterious gap is born when a pristine, untouched space is left behind between the highest tip of the first candle's wick and the lowest hanging wick of the 3rd candle. It looks like an empty window left open in the middle of a skyscraper. In the old tongue of the markets, we call this a bullish imbalance. To offer you a simple explanation as to why these empty windows hold such profound importance, you must realize that the market inherently craves balanced price action. To achieve this perfect harmony, the market demands a fair fight, with both buyers and sellers participating in the dance of price movements. Therefore, when we witness a violent surge upward where only the buyers take part, it rips a bullish imbalance into the fabric of the chart. The exact same phenomenon occurs when only sellers dominate the field and crash the price downward, tearing open a bearish imbalance. Following this undeniable logic, our empty window is an imbalance simply because it was a fiercely impulsive surge dominated entirely by buyers. What this means for our future is that we can expect this empty void to act as a powerful, invisible magnet. It will literally draw the price back down into its depths before continuing its grand upward journey, rebalancing the area. Naturally, we also have the bearish variation, which faithfully follows the exact same guiding principles. Picture 3 heavy red candles plummeting down your screen. The sole difference in this dark mirror is that the empty space points toward the downside. This means we calmly expect the price to inevitably push back up into it from below, striving to rebalance the fractured area before continuing its heavy descent. But keep a watchful eye. If there is absolutely no gap left between the wicks of the 1st and 3rd candles, if the wicks overlap and lock together like a tightly sealed stone wall, it simply means the price action is perfectly balanced. In that scenario, the market has left no footprint, and there is no gap for you to trade. Now that we have uncovered the true nature of these anomalies, let us embark on our first great lesson. The first secret is this: you should only ever cast your lot with FVGs that perfectly align with the current order flow of the market. The price, as you know, can only travel in 2 directions, yet it rarely marches in a straight line. Instead, visualize a staircase. It weaves through smaller, rhythmic steps, pushing up, pulling back, and pushing up again, which all join together to create the magnificent larger trend. In the glorious case of an uptrend, visualize that staircase climbing into the sky. For it to remain a valid, living trend, we need to see it continually forge new, higher peaks. But the moment a new peak is crowned, seasoned traders know that a pullback is expected. When that price tumbles back down the stairs, it desperately needs sturdy support to launch the next leg upward. This is precisely where we cast our gaze deep within the previous upward thrust, searching for an untouched, bullish, fair value gap to gracefully provide the liquidity needed to bounce the price higher. If you picture this unfolding on your trading view screen, it is a beautiful rhythm. Every time a new high is formed, you watch the red candles gently retrace back down into the waiting arms of that empty bullish window. Right there, inside the gap, it finds the exact support required to reverse and continue moving upward. As for downtrends, visualize a series of descending steps. The price must find a solid ceiling of resistance. Every time a grim new lower low is carved out, the price retraces back up, directly into the shadow of a bearish gap, striking its head on that ceiling before plummeting further. The golden rule is simple. During a mighty uptrend, only use bullish gaps. During a bleak downtrend, only trade bearish gaps. Moving further along our journey, the next piece of wisdom is highly cautionary. You should absolutely never place your faith in a gap that has already been touched by the price. Imagine you have found what looks like a pristine, untouched window on your chart. But Upon zooming closely, you realize a rogue wick from a later candle has already pierced into that space. Even if the price barely grazed the very edge, it is like a footprint in fresh snow. It is no longer untouched. We must consider it completely mitigated and greatly weakened. On a noble quest for only the highest quality setups, we leave the touched ones behind. For our next vital lesson, you must learn to hunt for gaps born exclusively within a discounted area. Allow me to paint a picture of this concept. Imagine you have just witnessed a massive, strong bullish surge up your screen. When you carefully highlight all the gaps left in its wake, you suddenly realize you have 3 or 4 to choose from. Which one do you trust? Well, imagine taking a measuring tape on your TradingView platform. You stretch it from the absolute bottom of that recent surge all the way up to its highest peak, and you slice it perfectly in half with a median line. This simple act of measurement reveals the premium and discount areas. If you are hunting for a long trade to ride the market higher, the setups hiding deep within the lower half of the discount area will always, without fail, be the strongest. You simply ignore the gaps floating near the top and patiently wait for the price to drop into the deep discount before looking to buy. Naturally, you flip this exact logic for bearish setups in a downtrend, targeting only gaps forged high up in the premium upper half. Now, my friend, we are venturing into the slightly more mysterious, advanced realms of our craft. This next secret dictates that you should always look to combine gaps across entirely different time frames to secure a far more precise, surgical entry. Imagine you have discovered a massive gap looming on the grand 4-hour landscape. Because of its sheer size on the screen, it gives you a remarkably large zone from which the price could reverse, making your risk uncomfortably wide. Instead of blindly throwing a trade into the wind, you use your tools to zoom deeper into the fractal nature of the market. You step down from the slow 4-hour chart into the fast-paced realm of the 15-minute chart. As you inspect the exact same upward surge with this new magnifying glass, you clearly see a tiny, pristine 15-minute gap formed perfectly inside the boundaries of the larger 4-hour gap. This smaller, hidden gem instantly becomes your new master target. It possesses the mighty confluence of 2 time frames agreeing with one another, creating an unbelievably fortified area of support. The next pearl of wisdom is that you should always consider the third candle of the gap's formation to be the most deeply important character in our story. When you see 2 highly explosive candles form, you already know the potential size of the gap before the third candle even begins to move. But what we are really watching, with bated breath, is how that fateful third candle decides to close its journey. If you are hoping for a bullish gap, but you witness the grim creation of a heavy red third candle, it instantly creates a treacherous formation we call a rejection gap. The third candle screams that the sellers are aggressively fighting back, warning you that this gap will likely crumble under pressure. But, on the brilliant other hand, if the third candle is an additional, wonderfully green impulsive candle pushing even higher, it creates something magical. We call this a breakaway gap. It leaves behind an empty space while proving buyers have absolute, undeniable control. These are exactly the gaps you want to trade. For our 6th lesson, you absolutely must understand the delicate art of trading gaps that form near the swirling waters of a liquidity area. The market constantly hunts for liquidity, which takes the visual shape of a previous glaring mountain peak, a swing high, or a deep valley, a swing low. Imagine a crystal clear mountain peak on your chart, representing a major resistance level. Suddenly, you witness a violently impulsive green candle blast straight through the top of that mountain like a rocket. This beautiful event is a liquidity run. The price has completely disrespected the old peak, confirming the buyers are ferocious. In this scenario, you desperately want to see a bullish fair value gap form entirely within that aggressive rocket move. That gap is the holy grail. But imagine a darker scenario. The price reaches for that same peak, but instead of bursting through, the candle pierces it with a long wick and closes its solid body below the peak, falling back down. This is a liquidity sweep. The buyers were exhausted. If a bullish gap somehow formed during that weak attempt, you absolutely never use it. The market signaled a massive reversal is imminent. And finally, you must strictly avoid trading these gaps when the market falls into the dark, murky waters of consolidation. Visualize a period on your chart where the price stops climbing stairs and starts moving sideways in a chaotic, messy zigzag, trapped in a tight box. During a clean trend, a gap is respected. The price bounces and creates a new gap. It is a beautiful rhythm. But when you see a perfect bullish gap completely fail, and then the very next bearish gap fails just as quickly, Your instincts should be screaming at you. The market has stopped trending and entered a chop zone. When you see two opposing gaps fail back to back, you are watching the footprints of confusion. Fair value gaps are not just random empty spaces. They are the literal, algorithmic delivery signatures of massive institutional players. When smart money injects billions into the market, their massive orders move the price so fast that it skips over price levels, tearing open these very gaps. By waiting for the right gaps, aligning with the order flow, and avoiding the sideways chop, you are no longer guessing. You are simply waiting in the shadows for the institutions to leave their unmistakable footprints, and then, with absolute emotional discipline and patience, you calmly step right into them.